from Money Watch, job growth in May here in the U.S. was lower than expected for the second month in a row. But strategists say that the lag in filling up job openings nationwide is still not enough to cause serious panic, and that the real test for the country's post-pandemic economy will be in reaching herd immunity. So joining us now to discuss this is on the nation's road to recovery. We want to bring in Chief U.S. Economist for Barclays Investment Bank, Michael Gapen. Thank you so much for joining us. More than half of American adults have gotten at least one dose of the COVID-19 vaccine. How closely are you watching vaccination rates, and how important is herd immunity to economic recovery?
Well, thank you for that question, Anne-Marie. We're watching it very closely. I actually think it's the number one most important assumption that you can make in terms of where the economy is going. You need to have an eye towards where vaccinations are and whether we get to herd immunity. And I think on that path, we're actually doing quite well. And so, as you mentioned, a little over half of the population has had one shot. It's about 63% of the adult population. And what that is doing is allowing for a decline in case counts and hospitalizations, and states are relaxing restrictions. And as I think everybody watching this show can see in their daily lives, activity is coming back. So that I think drives everything. From there, it is about kind of getting the mixing and the matching and the labor market kind of back to where it needs to be over time. But with the economy opening up, it gives a clear trajectory of where we're going. Now we debate about how fast we get there, and I think that is an important distinction.
So the recent numbers show that workforce participation is down, but wages appear to be increasing. What do you see as being the reason behind this trend?
Well, I think there's several reasons behind it. I can't tell you maybe which one is the most important, but I think it's a combination of things like, well, 50% of the country has one shot, but there's 50% who don't, and there's still, around 20,000 cases a day. So infection risk is down, but it hasn't gone away entirely. And if you're thinking about working in a face-to-face services activity, perhaps that is still a constraint. I also think only about half of K through 8 schools are open to full-time in-class instruction. So I think that's probably a constraint that should be relaxed or alleviated further into the fall. And then finally, there are the extended unemployment benefits, which are pretty good in terms of replacing wages at the lower end of the scale. So I think these things mean, people are taking their time coming back, and they will come back over time. It's just not going to be a flood back into the workforce in any given month. So I think these are probably the main constraints. And I think if we continue to get control of the pandemic, they should become less of a constraint over time.
So in the meantime, though, inflation rates have been sort of steadily ticking up. And some predict that when the May numbers are released this Thursday, that the yearly rate could be pushed closer to 5%. I've heard people sort of raise the alarm about coming inflation, but then I've also heard people say, yeah, but there are other factors that, will push that back down. What's your take on this? Are we heading into inflation, or do you think that there are other factors will even things out?
I think we're headed for a period of 6 to 9 months of higher than normal inflation. I think right now the U.S. is getting the worst of both worlds in terms of inflation, and by that I mean we're on the forefront of vaccinations when compared to the rest of the world. So our services activities are reopening again, and we're getting some of that deep discounting in prices and things like hotels and airlines and so forth going away. So some of the inflation we're getting is a normalization of prices. It's not really what we would think of as traditional inflationary pressures. We had deep discounting, airline fares are coming back up, hotel rooms and so forth. They're just moving back to kind of pre-pandemic levels and normalizing. Also, at the same time, we're ahead on the vaccination scale. The rest of the world isn't. So the global supply chain story is still pronounced. Things are gummed up. It's taking longer to get input. So input prices are rising and the cost of goods are rising. So we're getting both of those at the same time. At some point in the future, in the next 6 to 9 months, as the rest of the world gets vaccinated and some of these supply chain pressures dissipate and services inflation normalize, then I think inflation is going to come back down. But through the end of this year, maybe even into the first quarter of next year, we should expect rates of inflation, in the 3.5% to 4% range, depending on whether you're looking at the consumer price index or the index for personal consumption, which the Fed normally looks at. So definitely higher than normal for a period of time, but we do expect it to come down after that.
Michael, you've no doubt are aware that over the weekend, G7 finance ministers agreed to back the U.S. proposed global minimum tax of at least 15% on multinational companies. Explain to our viewers what this means and which companies might be most impacted by it.
So the way that I would describe this is we feel like we were in a race to the bottom in the sense that countries were reducing corporate tax rates in order to try and lure companies to relocate. And what that eventually means in the end is obviously there's a limit to how much we can do that. And in the end, what you just get is a lot less of income from corporate taxes. I think in the U.S., for example, corporate taxes are about 1% of GDP. They used to be 2.5%. And so I think what the developed world, at least in terms of the G7, has decided is, look, we need to kind of quit doing this beggar thy neighbor kind of policy. And if we put in a global minimum tax, that should remove the incentive for firms to relocate just based on the tax rate, and it should kind of even out how we're collecting taxes from households and corporates, for example. So I think it's just about leveling the playing field. And then in terms of the sectors that tend to be most affected, at least I think initially tech would be one of them. It's also suggested that healthcare would be another. But I think it's essentially about fairness in the argument and not trying to compete away and pull away firms from other countries into yours, because they can just turn around and do the same in reverse. So I think it's about leveling the playing field, and it's most likely firms in the sectors about technology and healthcare, I believe.
All right, Michael Gapen, always great to see you, my friend. Thank you very much.
Thank you.
CBSN